I'm here today to talk about Spheria and small companies and the LIC we listed about 18 months ago. So who is Spheria? We're a boutique, again part of Pinnacle. We were formed about 3.5 years ago, and the team has a heritage prior to that when we were together at Schroders of working in the small and microcap space. What do? We focus on cash flow. So one of the differences that I think we have versus many of our peers in the small company space is we do care about earnings, but we care more about cash flows and the reconciliation of cash to earnings. So in small companies, particularly more so than large companies, you'll find a situation where reported earnings aren't matched by cash. And that's a big problem when you've got stocks like Slater and Gordon and other stocks. And being a small company, you don't have much of an index weight. If you struggle in bad times, you have no cash flow, you try going to invest or going to banks with no cash flow to back up your earnings, and you'll have a really hard time getting funding. So we have a big focus on cash flows, which we use to both value companies and obviously gives us a good cushion, in times of downturns. So we focus on cash flows, on valuations and balance sheets. Obviously, we have a big focus on generating alpha, and we're also a boutique and very passionate about performance. What is the SEC? It's our version of our smaller companies fund. We IPO'd the fund in December of 2017, so about 18 months ago. The market cap currently is about 124 million. And it's managed, as I said, very much along the lines of our smaller companies fund. The average market cap in our fund is about 1.27 billion, so it's probably a bit larger than people expect. The range of those caps is everything from about 50 million up to about 3 billion. That we play that spectrum of market cap from very small companies, from microcaps right up to larger, smaller companies. It's a fairly diversified portfolio, so there's about 35 stocks in there. And the plan is to pay dividends on a semi-annual basis, which we've done since we IPO'd the company back in 2017. So what do we offer you, gentlemen and ladies, as investors potentially in our LIC? This is the performance of Spheria, the SEC, since we IPO'd. The dark blue line is the performance of our fund on a gross basis, I hasten to add, not a net basis. And the index is in the green. On a net basis, since we IPO'd, it's about in line with the marketplace. Now, that's not our usual record. We've typically beaten the marketplace by a long way. I'll come to explain what's going on in small caps a bit later on, but we've seen an incredible rush towards some of the larger caps and the more momentum-based kind of investments. They're the kind of stocks we don't typically play in because we think they're high risk and ultimately likely to come unstuck. So we've been able to keep up with the marketplace despite the fact that it's been rushing into these sort of very momentum-y growth kind of stocks, largely because we've been playing very good quality businesses with good cash flow generation that have seen quite a few takeovers. So there's been quite a few stocks we've had in our portfolio, like Navitas, like TradeMe, for example, that have seen bids from either private equity or other funds. And the other thing I'd like to highlight there is really the volatility. So I mentioned diversification in the fund, but also if you look at this period of massive correction sort of back end of last year, obviously we were down with the marketplace, but we fell much less than the marketplace. So we outperformed by about 3 to 4% during that really aggressive sell-off in October last year. And I think that's really what we try to do, because we do focus on valuations, we do focus on cash flows, and we do typically buy lowly geared balance sheets. In tough times, our portfolio tends to be a lot more resilient to the market than you generally expect in small caps. What are some of the big themes we've seen in small caps? It's been really a flood of money to investors who don't really do valuations currently. So the passive market and the quant market have taken a lot of money from active managers, particularly value style managers, so people who focus on low multiples or deep value companies. And what we did a year ago was we just went back and looked at all the smaller companies in our index and said, okay, let's rank those on a PE basis from the cheapest or lowest multiple through the highest multiple, and just look at those bands and see how those bands have changed over the last 12 months. Now, the quintile 5 there was the highest rated PE band a year ago. So the average PE there was 30 times. And you can see that's had a tremendous re-rating over the last 12 months, up to almost 118 times PE. The second, third, fourth, fifth quintile have obviously risen over time, but nothing like that top band. So what that's just demonstrated is that those growth stocks have had an incredible re-rating. In some cases, they've actually had earnings downgrades. That PE re-rating's been partly driven by the price and also partly driven by the fact that the E has come down. So stocks like WiseTech, for example, many of you will know, has actually had several earnings downgrades. Afterpay, which you'll all know as well, doesn't have any earnings. So it's on infinity PE. So we're in a pretty unusual situation where a lot of these very attractive growth stocks for some reason are just getting a massive re-rating. And part of that, we think, is the fact that quant funds and passive funds have been winning all this money at the expense of value style funds. The second consequence of that has been people have been selling out of microcaps. And what's interesting about microcaps is that over, say, a 10-year period, microcaps and small caps have typically performed roughly in line. what you can see here is the light green line here is the smaller companies index over the last 12 months. And then the dark blue one is the microcap or the emerging companies index. And that emerging companies index is underperformed by about 12 or 13%. But if you go back over 10 years, they kind of trade around each other, but ultimately those gaps close up. And what we're seeing with that flood of money to quants and passive has been a selling off of those microcaps, and we think that's a real area of opportunity. So I mentioned earlier that the LIC we run can span from the upper end of the small cap space right down into microcaps. And with this opening up of the valuation opportunities, we've been shifting some of our investments down to better value microcap. Just to give you, again, some context of the WAX stocks, many of you will be familiar with the term WAX. It's the WiseTechs, Appens, Altiums, Afterpays, and the Xero. They're the stocks that have particularly seen an incredible re-rating over the last couple of years. And you can see that the aggregate market cap of that group is now $30 billion, which is truly a staggering number for smaller companies. Along the bottom of that graph there, we have the aggregate EBIT, or earnings before interest and tax. And the total of that group is about $250 million of annualized EBIT. So that puts it on an EV to EBIT ratio, which is a typical valuation metric we look at, of 120 times, which is just mind-blowing for people like me who've been around for a while and used to old-style valuations. And we contrast that with a basket of stocks that we have in the portfolio currently, which is stocks like KISS FM, which many of you will know, is owned by HT1, Here, There and Everywhere, media company. Breville Group, I'm sure you guys will know that one, great quality business. Beacon Lighting, City Chic, etc., where the aggregate market cap is about $4 billion, in contrast to the $30 billion with the WAX stocks. And yet the EBIT earned by those 5 companies is actually $270 million, or exceeds the WAX stocks. Now, you could criticise that by saying, well, the WAX stocks are growing faster, which is the case, but many of the WAX stocks don't make any money yet. So it's pretty easy to grow fast, so you can just keep pouring money down the marketing pipeline without actually trying to get a return out of it. So there is the overvaluation in that particular basket of stocks is truly extreme. Why do we have an LIC? Well, a couple of things. I think it does give investors an access to the smaller company space where information is a bit hard to come by as a personal investor. Our team digs deep. Everything we have in the portfolio is modelled. As I said to you, we have a real focus on cash flows, valuations and balance sheets. So I think we're buying a really good quality basket of stocks that investors can't necessarily always determine themselves. We are capacity constrained, so being a small company investor, we don't have unlimited capacity. Like if you're a large cap investor, you can take on 10, 12, 13, 14 billion dollars of AUM. We've told all our clients from the outset that we're very limited in terms of what we can actually run. And so at some stage, our small companies fund will probably soft close, and the only way to access our product will be through an LIC product like this. So we are very concerned about capacity, so we can keep moving money around and outperform for our client base. And there's a point there, obviously, we do think we run a better quality portfolio than the average, which is more conservative with that cash flow. And so when there's a tough time in the marketplace, we think our portfolio will particularly prove to be more resilient than the average. So this is the NTA versus the share price since we IPO'd. You can see here effectively that during this sell-off period we performed pretty well. We've bounced back with the marketplace. We've paid 2 dividends since we IPO'd, so that is a 6-monthly event. Again, it's a board-determined thing, so I can't forecast that going forward, but it's very likely if we've got dividends from our stocks, we'll pay that back through our investors. Plus, over time, we realise capital gains, and we again distribute those back to clients or investors over time as well. And despite the fact that we've actually performed in line with the market since we IPO'd, we're now trading at a 15% discount, which is clearly frustrating for the team. And we'll come to what initiatives we're doing to try and close that gap. This is basically showing you the average of the smaller companies, LICs, that are listed on the stock market in Australia and their discounts. And what you've seen has been a bit of a malaise with that sector. There's been quite a few of them that have all traded. So we're trading in line with that sector, a roughly 15% discount, which again we think is unduly not reflecting the quality of the portfolio and how we've been running money. So to that end, we've been increasing investor communication with events like these. We publish a monthly update, which we detail how we invest, how we think, a couple of stock examples, so we go right into the process and peel it back so you can see how we operate. We're not just taking money and randomly punting it. We're doing some very serious work on all the stocks, meeting management teams, digging behind the numbers and making sure that free cash flow is real. We do webinars regularly, which you can download from our website and listen to. And then obviously more of these roadshows I think will definitely help the engagement. And then more recently we announced a buyback. So we've announced about a month ago a buyback of up to 4% of the stocks. Currently I think we've bought back $350,000 worth of stock at a discount. So that will actually definitely increase value over time for the remaining shareholders. And then lastly, a good chunk of the shares are owned by the staff. Not included in that number there are some shares owned by my parents and my stepfather. So I kind of joke to people that, if this doesn't work out, I've got no family, no friends, no money, no job. So, we're heavily committed to this product and to Spheria. That pretty much wraps it up. Thanks very much.